Okay, we'll go ahead and get started. Good morning, good afternoon, everyone. My name is Jason Mishaw. I'm one of the financial advisors here at Bogart Wealth. Thank you for taking the time to join me on the webinar today. We're going to discuss what if retirement comes earlier than expected. So a couple administrative items. I do have the question and answer box open as well as the chat box. So I'll do my best to answer questions as they come in, and hopefully I'll try to get to them before the end of the presentation. Also, this is a recorded webinar, so we will be putting it up on the website as soon as it's available for you to view later as well. So just a quick introduction about Bogart Wealth. We're what's called a registered investment advisory firm. We manage about $1.6 billion of assets under advisement, about 850 households. 90% of our clients are major oil company, either current employees or retirees. We are a fee-only advisory firm, so we act as true fiduciaries for our clients, which means we're legally obligated to put our clients' interests above our own. No hidden agendas, no conflict of interests. As fiduciaries, our core competencies are financial planning, investment management, tax optimization, and tax preparation. Our team, we have about 21 folks as part of our wealth management and planning team. We also have a tax team of 4 individuals with whom we engage for our clients for tax preparation as well as strategic tax planning. We have 3 office locations, headquartered in McLean, Virginia, and then 1 in Houston, Texas, in the Memorial City area, and then 1 in the Woodlands for our clients' convenience. One of our primary missions is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. We know that the impact that planning can have, especially starting at an early age. So we make it part of our firm's culture to give our clients, children access and parents access as well to our certified financial planners. So just giving them guidance early on gives the ability to make some decisions that they can have a cascading and material impact long term. So that's definitely embedded in our culture. One of the calls to action from any one of our educational events is that we do sit down and run your numbers in a one-on-one financial strategy session. Absolutely no cost, no obligation. It's a great way to get to know our firm a little bit better and then also get some real data on your situation. Particularly in this environment we've had the past year, we're big believers that you should put yourself in a position to be able to make decisions quickly. Landscape is continuing to change with energy companies as we see in this past year. So having that ability to act quickly and having that financial plan in place is very important going forward. So today's talk is kind of a derivation of what we call our retirement readiness series. We have 8 kind of core educational events that we do and have periodically webinars with those as well. Some are repeats, some are being updated, but we do one on retirement planning, retirement income planning, Social Security planning strategies, tax planning, tax law changes, estate planning strategies, NUA, net unrealized appreciation, and post-retirement strategies, long-term care planning, long-term insurance discussion, as well as Roth versus traditional 401k or IRA savings. So these are some of the topics we typically focus on. If clients or prospective clients ask us questions, we'd be more than happy to add a talking point at a minimum to one of our existing presentations, or if it warrants a new presentation, we'd be happy to do that. So if there's anything else you'd like us to discuss, don't hesitate to reach out and let us know. Okay, so kind of going on to our agenda for today. So obviously getting into what happens if retirement were to come sooner than expected. And we've kind of taken some of the different segments from those previous presentations to compile things that would be particularly relevant to look at today if we have an earlier than planned retirement. So we're going to talk about why you should engage in retirement planning, why it's important, and then, of course, talk about some of the key risks from a planning perspective that you want to address in your retirement plan, and then kind of go through the retirement planning process itself, looking at the different components: analysis, investment strategy, withdrawal strategy, and then, of course, strategies to kind of review and monitor your plan as time goes on, you get closer to the actual retirement date. So key thing with retirement planning is it is definitely a process. It's not just one specific event when you get to your retirement date. And so as this process, we've kind of broken it down to the various stages that we've looked at and addressed previously: initial analysis, investment strategy, withdrawal, monitor, and review. And so see how all those processes organically flow from one another. So when we talk about a retirement plan, excuse me, let me go back here. When we talk about a retirement plan, really want to start with, why does a plan matter? And we want to be able to plan to minimize risks that all retirees must address in order to make informed choices regarding how they're going to fund the retirement. Not only how you're saving to get ready for that, where you're saving, how much you're saving. We also want to be able to understand what your expenses are in order, kind of ensure, predictability for your retirement income stream. And then also, based on that, determining sustainable withdrawal strategies to make sure we don't have longevity risk and we outlive our portfolio. And then again, putting those maintenance elements in place as we prepare for retirement, going to retirement, to make sure we're on track. So, we kind of talk about what is important to you. This is kind of getting into the emotional side of retirement. And it's really about, our clients creating the vision for what they want to do, what they envision their lives in retirement to look like. And then, we help translate that over into, okay, what are the living expenses that a typical retiree is going to have, and what kind of pitfalls could we engage in once they get into retirement. So again, of the considerations, family, what impact is your family going to have on your retirement plans? Do we have parents that we need to support either with medical help, financial help? Do we have children we still need to support? Those are definitely big components of your retirement planning. In terms of your health, how will you plan on staying mentally, physically active through retirement? And then how could changes to your health or your spouse's health impact your retirement plans? Additionally, your home. So where do you plan on living in retirement? Do you plan on staying put? Do you plan on getting a vacation home, relocating somewhere else with a different cost of living? Or do we need to retrofit our home to prepare for old age? So those are another important factor as well. And then we kind of go on to, lifestyle choices. So what activities will give you the most, satisfaction in retirement, and what are the expenses associated with those? Additionally, some of our clients, they derive satisfaction, enjoyment from continuing to work, maybe on a part-time basis. So are we going to have some sort of income stream, part-time work, something to keep engaged? And then, looking at the legacy, is the goal to leave a legacy for our family, for our children, or for a charitable bequest or something to that effect. And then, kind of bringing those all together with that emotional component, as I said, the mind and spirit, how do these things provide emotional fulfillment for you, and then helping bring the planning in to make sure we accomplish those goals. So if we look at a survey that was done for people getting close to retirement, what was very consistent is if you kind of look at the responses and the number of folks who agree with these phrases. So for example, making sure we had a secure, reliable retirement income, 79% of respondents verified that as being very important. Income that keeps up with inflation, 73%. Not worrying about having enough money was 58%. And then down the line, we have supporting family members financially, volunteering, sports, recreation, et cetera. I think what's very telling from this, the surveys, what we kind of consistently see with people getting closer to retirement is, the top considerations are always about money and financial concerns. So, that kind of stresses the importance of making sure you have that plan in place to address those concerns as you're getting closer to retirement. So when we look at some of the key risks that you want to account for in your retirement plan, if it comes up unexpectedly. So first, of course, is longevity. If you look at the IRS mortality tables from 2019, for the average couple age, both of whom are age 65, there's a roughly 50% chance that at least one of you will live to age 90, a 20% chance that one of you will live to 95, and a 4% chance that one of you will live to 100. So it's very important that given these longer life expectancies, doing your retirement planning to make sure we have that longevity risk built in there to address. Secondly, inflation, which is getting a lot of headlines recently. So it's been interesting in the last 5 years or so. Prior to 2021, inflation hasn't really felt like a material impact. And then, of course, this year, as we've had reopenings, increased demand, we've seen kind of supply chains that were materially negatively impacted in COVID try to keep up. So we've definitely seen cost increases over the past few months. The question is, what component is a traditional supply and demand issue that's going to be more transitory versus increase in the money supply, debt levels that leads to longer term inflation. So that's something we definitely need to account for in the plan. But just kind of give an example of the reduction in purchasing power. A 3% inflation rate will cut your purchasing power over 50% in 25 years. So taking $50,000 down to about 23.8 in today's dollars. So that's something we definitely want to account for. And then very important is also market performance. So sequence of return. So basically indicating, in the early years of retirement, if we have a series of poor returns, that could detrimentally impact the financial plan. So that's something we have to account for in our investment management. And then as well as volatility, if we're forced to sell assets when we're in depressed prices. So going back to March of 2020, a very good example, rather than kind of holding on and being able to recover, those could, both actions could have very detrimental impacts to the financial plan. And then last, healthcare. So healthcare costs have been increasing at a simply higher rate than inflation for other goods and services. So, looking at recent studies about estimating what healthcare costs are, the numbers just keep getting bigger and bigger. So this is something that you should account for when your retirement planning is, current assumptions for healthcare expenses, adjust those to a greater degree. Okay. So, one thing it's very common for us to say is, there's no such thing as an average retirement. Everyone's going to be different in terms of, what they spend, where they want to live, what's important to our clients. But we have to rely on historical averages to kind of help translate and forecast what those needs are. So that helps us establish a baseline for the plan. So in terms of, spending, longevity, using those life expectancy tables, using historical market returns, looking at taxes. So of course, one variable, the tax environment could certainly change, and that's been in the headlines recently. One thing we know for this, if we maintain the status quo at the end of 2025, many of the individual components of the Tax Cuts and Jobs Act are going to expire that were passed at the end of 2017. So we're going to revert back to the previous tax rules. So we know at the minimum, if no action is needed or no more legislation is passed, we're going to have a change there. So again, that's one of the variables that we have to take into account and look at as well. And then we talked about the inflation component a moment ago. Okay, so if we want to kind of prioritize our goals, and set realistic expectations of how we're going to achieve them, establishing kind of how much income you need and when you're going to need it. What's very common, what we see with folks who go into retirement is we actually kind of have a graded level of spending. So what we kind of refer to as the go-go years, the slow go, the no-go. Go-go years, first couple of years of retirement, clients are still relatively young, relatively healthy. So we typically see higher levels of spending, so more discretionary expenses, travel, visiting family, et cetera. And then as we tend to get a little bit older, travel tends to slow down, some discretionary expenses slow down. And then we get to the no-go phase where we have very little in the way of discretionary spending. And then we typically see healthcare costs start to creep up at that point in time. So in terms of estimating expenses and accounting for this kind of differential spending in these periods of time, breaking down what are essential expenses versus discretionary, and then of course having in reserve those unexpected expenses, and or if we have gifting goals for family members, wealth transfer, or to charity, incorporating those as well. So when we go to essential expenses, of course, we're talking food, housing, healthcare, insurance, utilities, et cetera. Discretionary being entertainment, travel, gifts, clubs, and memberships. It's a very fascinating exercise to talk to clients, couples, and see what one spouse categorizes as part of their baseline essential versus another spouse will indicate as discretionary. So it's important to kind of establish, kind of break these down so we have kind of the baseline essential expenses, and then we can always change over the years as we get closer to retirement. And then addressing the kind of follow-up questions about setting aside for emergencies, repairs to the house, et cetera. And then, of course, incorporating that inflation adjustment or cost of living adjustment in the plan. Okay, so as I mentioned about the inflation assumptions regarding healthcare, what we've seen historically, healthcare costs are increasing faster than the consumer price index is changing. So what we typically do is kind of break out healthcare costs and build in higher rate of inflation for those. And then on top of that, building in extra costs down the road. So for example, long-term care event, nursing home care. And so looking at potentially long-term care insurance as a means of ensuring and protecting the estate from depletion due to a long-term care event. So that's something important to look at as well. And then going to the next process of identifying income sources, where we talk specifically about Social Security, employer pension programs, personal savings investments, so 401ks, et cetera, rental income, business or employment earnings, and then put those income assumptions in there, and then we can stress test and change those. So again, very, very common case right now, what we're talking about today, an individual working in an oil company may anticipate working well into their 60s. But given the work environment now, if we're forced to retire early, how do we modify that assumption against the base case to see if those years of foregone income materially negatively impacts the plan? So something very important to take a look at there. So if we look at Social Security, and we also have a whole separate presentation on Social Security that's on the website, so feel free to watch it or download it. We'll have that periodically come up, which does a more in-depth dive into Social Security analysis and optimization. But kind of talking in general terms, Social Security, of course, was never designed to completely replicate 100% of anyone's income. For folks on the lower end of the income spectrum, it will kind of tend to replace a higher percentage, up to 90%. For kind of the median U.S. household, it replaces about 40% of pre-retirement income. And then for a typical oil industry employee, it'll be in the range of 10 to 30%. And then if we kind of look at the pension, the employer pension, if we look at the fixed annuity at ExxonMobil, for example, it's designed to replace anywhere from 12 to 65% of someone's earnings, again, depending on duration of employment with the company, and depending on the Social Security benefit. And it's a pretty straightforward calculation, 1.6 times years of service times average pensionable pay. And then there's a Social Security offset as well. So for the typical career employee at ExxonMobil, for example, it's going to replace 50 to 60% of their pre-retirement income. So kind of looking at those two fixed sources of income, Social Security and pension, we have, again, 10% replacement Social Security, 50% with pension. That gives about 60% of our pre-retirement income. So, again, the typical client is not going to be happy with living off 60% of their pre-retirement income. So we have to make up the delta from other components of saving investment. So the 401k, IRAs, et cetera, to fill in that gap. And so the question arises, how do we optimize the distribution from those components in a tax efficient manner? Okay, so as an example, kind of looking at that Social Security replacement component, at the lower end of the spectrum, you can see the income replacement is higher. As we increase our median income, we see it continues to drop. So for example, 142,000 of income, Social Security is replacing about 27% of that going into retirement. So definitely consideration to take into account. And then of course the pension benefits. And again, we have a whole whole webinar that kind of goes into calculations in depth. But the basic idea of as years of service increase, your pension benefit will materially increase as well. So we can kind of see the 15-year minimum years of service, and then the greater years of service, the greater appreciation there. Okay, so if we kind of, as part of the planning process, it needs to be very holistic in nature. So we're looking not only at cash flow needs, but these different components, investment, the risk factors that we've talked about, integrating tax and preparing for different tax regimes. And then as you're building out this plan, it needs to be stress tested, looking at different rate of return assumptions, different spending assumptions with Monte Carlo simulation. So it's very important to understand, what are the sensitivities within your plan, be it movement in interest rates or what have you, and then, analyzing those to help make the best decision that you can. So, as a quick example for our ExxonMobil folks, a very common scenario that we look at is the potential for net unrealized appreciation, where we have Exxon stock inside the savings plan that we can get preferential tax treatment for. So we look at analysis of different cost basis ranges that we perform this NUA transaction in retirement and help optimize the decision. So that's an example of kind of one of these optimizations that we perform for our typical ExxonMobil households there. And again, I encourage you to look. We have another webinar that looks at NUA in depth, so it gives you a much deeper dive into that process. Okay, so kind of going on to the emotional components of the plan. So we know that fear and greed are very powerful emotions in the human psyche, and they can definitely lead to very adverse investment decisions, leading someone to buying high, selling low. As humans, we're wired completely backwards. We tend to react very adversely when things are not going well. And then tend to be complacent when things are going well. So, the process of putting together the retirement plan, investment plan, is understand what the needs are to help us build a portfolio in such a way to help protect to the downside. So is it, incorporating investments of lower risk, bonds, fixed income, and then also just making sure that we have a foundational level of income to protect the essential expenses. So that gives us some leeway. We're not forced to sell when the markets are down, that we can generate enough income to get by until the markets recover. So again, the strategies for withdrawal in volatile markets, spending strategies, that having this plan ahead of time is very important, because again, when we start to encounter emotional reactions like we did in March of 2020, we can certainly deviate from what optimal decision making is if we don't have that plan in place. Okay, so if we kind of look at transitioning into the investment strategies, I'll kind of provide an overview of some of the basic strategies here, and then we'll kind of talk in a little bit more detail. So again, we have annuities, annuity products, bond ladders, income-oriented investment, so a high dividend yielding portfolio, and then looking at different asset allocation approaches. So, fixed asset allocation is more modern portfolio theory, and then we also have dynamic asset allocation that we'll kind of look at as well. So, looking at the three kind of basic annuity options. So, we have the fixed annuities, indexed, variable. Fixed annuities are similar to a bank CD, but they're not FDIC insured. They pay a fixed rate of return, typically longer term in nature. The funds are actually held in one common commingled general account. If we kind of contrast that with the other end of the spectrum, variable annuities, so the best way of describing them is they're a lot like mutual funds. They're going to fluctuate based on how they're invested with market movement. So it's a market-driven rate of return, and these are held in separate accounts, so your assets are not commingled with anybody else's. And then a hybrid of the two is the index approach, where we do have participation with the market, but we're capped at either a underlying level or floor, so we don't participate in all the upside or the downside. And then these are also held in a general fund as well. So again, you could look at annuities in the open market. So for example, if you take your lump sum and with your pension, you retire and you go buy an annuity. So for clients whose risk profile is such that their propensity, they want to have a guaranteed level of income, then we also look at, of course, the ExxonMobil annuity and compare that to annuities on the open market. And nowadays as well, in the past where it used to be 100% lump sum or 100% annuity, now we have splits where we can do 75% lump sum, 25% annuity, or 50-50, depending on our clients' risk profiles and risk aversion. Okay, so if we go to slide, and I had a question come in So FDIC insured. So the fixed annuities are not FDIC insured like a bank CD is. So I hope that answers your question, Sean. Okay, so if we go to the next piece, which was the bond ladder, and again, this is a very simple example, but let's say we have 300,000 to invest. And so we're going to break it down into the first 100,000 goes into a bond with a 1-year maturity. The next 100,000 goes into a 2-year maturity, and then the following goes into a 3-year maturity. So we mature each year. So we have a liquidity event. So if we need to pull money for living expenses, we can, and if not, we just reinvest it into a new 3-year bond and keep the process rolling. But the idea with the ladder is we have a liquidity event each year. So, we have the option of pulling it for living expenses and reinvesting it. And then, of course, the goal of the bond ladder is we're going to, generate an income stream. But now with interest rates as low as they are, it's a little difficult to do. So I had a question about, how are bond ladders typically invested? So we can do a number of different strategies. So we can stay very low risk in, government-backed bonds, so treasuries or mortgage-backed securities. We can also do corporate bonds. Tend to, focusing a little bit more on, higher quality, so triple B and above. But you can do ladders with any type of bonds. But if they're primarily for income and liquidity each year, then we want to reduce credit risk and stay a little bit higher quality with the bonds there. Okay. And then if we go to kind of looking at current yields, again, as we mentioned with the bond ladder, the goal is we're generating income and yield. So right now that's very difficult to do. If we kind of look at treasury yields, short-term, intermediate, longer-term yields, corporate bonds, if we're kind of looking at AAA, a little bit sub 3%, and then we have mortgage-backed securities. If we're kind of looking on the equity side, preferred stocks, which have preferential claim to dividends, then common stocks, they tend to have higher dividend yields. And then we can also look at higher dividend paying stocks as an example. Excuse me. But as you can see with kind of the bond ladder or pure income, with the yields where they are, it's a little bit difficult to kind of generate very strong yields in this environment. Okay, so if we look at the kind of the dividend paying, high dividend yielding stocks. So a lot of our clients are Exxon folks, for example, and they like the dividend yield. Currently Exxon is kind of around a 5.5%. Dividend yield. It used to be much higher when the price is lower. So, that's been a strong, consistent dividend payer. If you look at the rate at which it's grown, kind of grown at an average rate of 6% per year, 6.1% every year the past 38 years. So we have had dividend growth. The issue is, of course, we've had price return issues. So as we see here, price dropped in 2020, and this is not up to date, not reflecting the strong performance and partial recovery in 2021. But the idea is, and I just want to bring you an example, a model that we use at Bogart Wealth called Prime Income, where it's a very diversified approach, pays, close to 4% dividend yield, and provides diversification at this, significantly above holding one company. So, what we've seen is one of the big, risk factors, of course, as you're getting closer to retirement, is concentration risk. So this is something that we stress with our, energy clients quite a bit, particularly as they get concentrated, if they get stock grants, purchase stock through a stock purchase plan, et cetera. So very important, kind of emphasizing, still looking at generating income through high dividend paying stocks, but being diversified while we do so. Okay. So kind of transitioning on to the asset allocation, kind of modern portfolio theory model. So, looking at this, this is, similar to kind of a, index tracking approach. Looking at a portfolio that is 100% stocks, historically we've had, better returns, albeit higher volatility and risk. And looking on the x-axis of this graph, we measure risk in terms of worst annual drawdown, worst year, and percentage loss. So, clearly, Longer term equities have had higher performance, higher risk and volatility, contrasting that with 100% bonds, lower risk, lower return. So the idea is if we can index and combine, portfolios of stocks and bonds, we can actually reduce the level of risk along the y-axis and still get higher returns. So for example, 40% stock, 60% bond, we're getting a higher average return from 1980 to 2018 than a pure bond fund. So reducing the risk and getting higher return, again, because of the low correlation between stocks and bonds. So a good consistent overall return with taking less risk. So kind of in the savings plan, when you've got your equity units, bond units, extended market units, kind of the indexing and blending these strategies to kind of optimize your risk adjusted return is something that, we definitely like while you're in the accumulation phase. The problem in the drawdown phase is there's not necessarily a withdrawal strategy associated with that. So in a bad market environment, we have to be, very selective about our cash flow mechanism, make sure we're not touching assets that are in a downturn. So, but very common approach. More passive approach. If we talk about now going to dynamic asset allocation. So, anecdotally, just to kind of illustrate the point here, very interesting piece of information. So if you kind of look at the start of the 20th century, railroad stocks were almost 65% of the US equity market. If we look a century later, they're less than 0.5% of U.S. equity market capitalization. Also, if you look at size of country economy, so Russia, India, Austria, Hungary were 25% of the global equity market before 1900, and today they're less than 1% a century later. And then within the last 10 years, we've seen the rapid growth of the technology sector as a component of S&P 500 U.S. equity markets. So the scale of these changes, is very, I'd say, as it says here, a very powerful challenge to investors that, we should be extremely passive to accept whatever happens in the market, and that we should be a little bit more responsive to opportunities as they present themselves. Another point to dynamic asset allocation is, looking at, multi-year declines. And being able to respond and adapt to that. What's worked in the past is not always going to work in the future. Particularly when we're in environments when we have these sustained drawdowns. And thankfully, if you look at these multi-year drawdowns, 2020 was not in this chart. We were able to recover and actually end up positive for the year in 2020. So I think everybody was very, very thankful from that from a financial markets perspective. Okay, so we kind of talked about dynamic asset allocation. So it's a process, not a timing method by any means for the markets. So it's based on actual trends in terms of relative strength measurements of different asset classes, and then ranking and scoring them against each other, looking at this relative strength, also looking at flow of funds between different sectors or asset classes to help kind of determine what market price trends are going to be. And then, so it's a very systematic approach. And then also looking at, market reaction to geopolitical factors, managing the economic cycle. So economic downturns, upturns, industry sector changes, and then interest rate changes as well. So we rank these asset classes on these relative strength factors, and then we kind of align our allocation to those stronger asset classes. And this is a little bit more systematic approach for adjusting and looking at these changing conditions. So one other interesting piece, if you kind of look at this graphic, we call the periodic table of investment classes. So each investment class is color coded, and this ranks the relative performance in a given year going back to 2001. The trend kind of looking at this is, not every asset class is going to do well every year. And we see definitely a lot of variation. So one leads to the benefits of diversification, and then two, dynamic asset allocation as well, to be able to adapt to a changing market environment in which you have a lot of movement and relative performance among these different asset classes. Okay. Okay, so kind of moving on from the investment strategy to the more of the withdrawal strategy. We'll kind of talk about three concepts here in terms of withdrawal strategy. First being income only. So we're withdrawing only interest and dividends from the investments. The caveat with this one is the portfolio has to be of sufficient size to generate enough yield to not touch principal. And then secondly, we have to be in probably a higher yielding environment than we currently are now. The bucket approach, as the name implies, is we actually create specific portfolios that are going to design to handle either our immediate, intermediate, long-term needs, and then we adjust the risk profile accordingly. And then the last one, the systematic withdrawals, as the name implies, it's a prorated distribution from all your portfolio, well-balanced portfolio. Doesn't matter what the market is doing. If we're an up cycle, down cycle, kind of same consistent prorated approach. So again, each of these has some upsides and downsides. So we'll kind of talk about those as well. So. Okay, so for an example with the bucket approach, an example using pretty easy numbers. So let's say we have a client who has a portfolio about 1.5 million, and we have about 60,000 that we have supplemental income we need to pull from this portfolio. So in the first 5 years of spending needs, 300,000, we're going to have visibility on this source of income. We're going to be invested in very low risk. So we're going to be potentially money market, shorter maturity bonds, investment grade bonds. So very low risk. And then as we go to the intermediate bucket, so adjusting for inflation, we say at this point, living expenses are nominally 7,000 a year for 7 years, that we're going to have incorporate more higher risk, higher yielding bonds, more equities. And then as we generate income from the second bucket, so interest and dividends, we can just distribute over to replenish bucket one as time goes on. And then the last bucket, the third bucket, maybe from an investment perspective, the most exciting, we're going to be, more aggressive growth, maybe smaller cap stocks, mid cap stocks. So looking for higher long-term return there, again, because of the time horizon that we don't have to touch the money there. So this is kind of a basic example with the bucket approach, is designating specific portfolios for specific time duration needs. Okay, so again, what gives us great visibility on the longevity of a portfolio is what the withdrawal rate is going to be. So looking at an inflation, an investment return of compound growth rate of 5% per year, coupled with inflation at 2% per year. Historically, that's a more conservative number. If we look at a 3% withdrawal rate of the portfolio continues to grow, and then you can see as the withdrawal rate increases, the duration that the portfolio lasts continues to shorten. So for example, if we've got 5% nominal return, 2% inflation, so 3% real rate of return against an 8% withdrawal rate, taking that, is going to be roughly 14 to 15 years to depletion. So that definitely gives us insight as to longevity, is looking at what the average withdrawal rate from the portfolio is going to be. Okay. And then, in terms of optimizing our withdrawals, right? So if we look at the different types of, sources of income in retirement, knowing the taxable nature of them is going to be very important. So for example, Social Security, in the vast majority of cases for our clients, up to 85% of that benefit is going to be taxable as ordinary income. For people who are lower income, it could drop to a threshold of 50%, or maybe potentially even 0%, but that's for a very low threshold of income. If we're taking pension income or annuity income, interest, 401k distributions, IRA distributions, that's all coming out as ordinary income. And then if we have dividend income or capital gains coming from a brokerage account, those are going to be taxed at preferential long-term capital gains rates, which we'll talk about more in a second. And then, of course, Roth IRAs are going to not be subject to any taxation, provided you, at least the earnings component, you've held it for at least 5 years and are 59.5, and your contributions, which were done on an after-tax basis, you can pull those out at any time, not subject to tax. And then if we have a in an after-tax account, if we have a stock and we liquidate it and we have no gain, the principal, you can be returned to you on an after-tax basis. So, making sure we have a handle on these different types of income distributions we can take, and how do we optimize based on their treatment, which we'll kind of go to kind of talk about here. So, one of the things that's very important to know is under our current structure, capital gains tax rates are always going to be less than ordinary income tax rates. So we know that, ordinary income tax rates, 10%, 12%, 22%, so on and so forth. If we look at the capital gains tax rates at the same levels of income, you can see that 0%, then the 15%, and then 15% plus the net investment income tax of additional 3.8% makes 18.8%, and then the highest is 23.8%. So this definitely gives us an opportunity based on these differential and tax rates to take advantage and do some tax planning. So for example, we have clients who recently retired. They're going to be in a low ordinary income tax rate, the 12%. If they have stocks that are highly appreciated, we could potentially sell them and pay no capital gains on the appreciation while staying within this bracket. And then conversely, if we have someone who just retired, got a big non-qualified supplemental payout, and they're in a high marginal bracket, we would hold off and defer any liquidation of any taxable gains until a subsequent year when it drops. So again, taking advantage of the differential in rates and addressing this on an annual basis is very important, and that's what we help with assist our clients with. Okay, so again, going to that issue of managing these distributions, again, generally, which accounts do you distribute from first? Generally, it's the non-qualified accounts first, then the qualified, and then Roth. This is a good general rule of thumb, but is not always the case. For example, if we have no income and we've got cash we can live off of, very commonly we can take distributions from retirement accounts and pay ordinary income tax and fill up the 10% and 12% brackets, or do Roth conversions at those lower rates. So you pay lower tax on taxable distributions in a year with no income. So again, that's a general rule, is not necessarily the most optimum. Running different scenarios, looking at that would be very helpful to assess that. Another important thing is managing your required minimum distributions, acronym RMDs. So these under current law start at age 72. And so, required minimum distributions force you, whether you need the income or not, to withdraw a certain percentage each year. And this percentage increases with age. Of course, you can take out more if you want to, if you need it for living expenses, but there is a government mandated minimum. The IRS wants to get their money at some point. And so, very important is if you fail to take your required distribution in a given year, the tax penalty is 50% of the undistributed balance. So a very steep penalty if you don't do so. So very important to make sure you have that handled by the end of the year. So the idea is, how do we manage those? As I alluded to earlier, if we have the opportunity to do Roth conversions or take distributions in earlier years at lower rates, that reduces the overall balance such that it mitigates the taxable impact of some of these required minimum distributions down the road, because we've seen a lot of cases where clients accumulate a big 401k pension lump sum, and then they live off after-tax expenses, so they let it continue to grow and compound, which is very good. But if you're growing, compounding these pre-tax dollars at 72, you're going to get hit with a big tax bill when a chunk of that has to come out. So very important to manage those distributions, longer term planning. Okay, so one of the things that's been kind of bandied about is a proposal to adjust the required minimum distribution schedule and potentially increase it a little bit. So prior to 2018, required minimum distribution started at 70.5. They were pushed to 72 as of 2018. And so starting at age 72, the percent you have to take out is 3.9%, so roughly 4% of the balance of the account at the beginning of the year. So if you have a $2 million in total 401k, IRA, pension lump sum, what have you, that's going to be about $80,000 of required income that's going to have to come out. And then you'll notice that the distributions increase over time. So when you get into your mid 80s, you're going to be required to take out 8+% of the balance of your qualified retirement accounts. So with this new proposed distribution schedule to account for increased life expectancy, they're proposing smoothing it out a little bit. But in the first 15, 20 years, there's not really going to be a material difference. But the big picture is because of increased life expectancies, potentially spreading out the required minimum distributions over a longer period will give you a little marginal tax benefit there. But the idea is definitely want to be aware of these potential impacts down the road. Okay. So I have one person asked about if retired before 55 and invested for pension service. So we'll actually talk about strategies for that in just a minute here that Patrick asked. And I think it should be one more slide over, or a few slides here. Yeah, and Thomas, to your point, going back to this question, as I mentioned, there's in the proposed schedule, there's no material difference. If you look, it's the differences in distribution percentages. It's 1/10%, 0.2%. So in reality, is it going to have any material impact? No, but again, this is still a proposal, and is nothing is set in stone. But the trend has been in line with increased life expectancy to kind of continue to push the distribution schedule a little bit further down the road as we go through. Okay. So kind of reviewing and monitoring the progress of the plan. So again, tracking what your asset level is. With the planning, are we higher or lower than what we projected to be? Looking at income, did we accurately project what we'd be seeing in retirement? And then spending, and this is kind of one area where the advisor can provide an accountability point with what our projections were going into retirement. Are we accurate down the road as we get a few years into it? And then of course goes without saying, the market conditions, how has the portfolio been doing then compared to what we've estimated there. And then in line with what the spending needs are, has that material impacted the rate of withdrawal that we projected? And as I mentioned, that's a significant, can lead to a significant change in the feasibility of a retirement plan if the withdrawal rate changes substantially, increases, and could, particularly if we have those sequence of events, return issues with poor performance. And then of course, inflation, and then our changes in expectations for goals for retirement there. Okay, so then kind of as I mentioned, kind of look at these foundations and then the optimizers. So that initial cash flow projection that we have is the foundational plan. And then we look at changing our withdrawal strategies if we're doing Roth conversions or NUA, and doing that sensitivity analysis to make sure we're kind of as optimal as we can based on the information that we have and that we can project. Okay, so yeah, I can't stress how important it is to have a plan. And one of the things now that we kind of wrapped up, I want to talk a little bit about the kind of pension rules. Again, we have a designated seminar or webinar, excuse me, to kind of look at that. But basically the idea is for those who are over 50 at the end of 2007 and had more than 10 years of service before that point, they were grandfathered under the old pension calculation rules prior to the Pension Protection Act of 2006. So, born before 58, hired before 1998. So for the discount rates for calculating the lump sum, they actually use 95% of what the 30-year Treasury bond rate is, rounded to the nearest 1/4%. And they actually use the mortality tables from Exxon 2000 mortality table. So most of the clients are not going to be in this situation. They're going to be the after 2006. But just so you're aware, if you do fall in this category, the calculation, if you're looking at a pension lump sum, is done differently than for folks who don't meet these criteria. So kind of looking at what we see as our the data for the interest rates on the 30-year Treasury, kind of looking into second, third, fourth quarter, taking 95% of that. This is the discount rate used to calculate the lump sum. And again, I'll kind of breeze through this as there's an in-depth webinar looking at this. So kind of transitioning for everybody else who is subject to the Pension Protection Act of 2006. So i.e. you weren't 50 at the end of 2007, the new rules apply. And so basically what these rules did is rather than applying a single 30-year Treasury rate to all discounted cash flows, they created these three segmented rates based on high quality corporate bond yields. And they publish those on a monthly basis on the IRS website. Basically, the idea is if you're looking at and so the one thing to stress is that the segment rates, they have no bearing on the annuity calculation whatsoever, right? So if we're looking at the annuity, segment rates have no impact on that. They only impact the calculation of the lump sum. So the idea is higher the interest rates, higher the segment rates, that reduces the value of the lump sum. So we say higher yields are bad when looking at the lump sum. And then another factor that's used to calculate the lump sum is the life expectancy from the IRS mortality tables. So the longer the life expectancy, the more payments, annuity payments you're expected to receive. And when they discount more payments back to the lump sum is higher as a result. So again, higher interest rates are bad for the lump sum, but longer life expectancy is good for the lump sum. And so I mentioned this, these are people who are born after 1957 and or hired after 1997 are subject to these rules. Okay, so this is kind of a trend, and we send out our email on what we project the discount or segment rates to be. So if you don't receive those emails, feel free to reach out to us. We'd be happy to put you on our list. But we kind of basically tracking what the actual published segment rates are by the IRS, and then what we model them to be based on market interest rates. So we can see the trend clearly, as I'm sure a lot of our folks who are looking at retirement are aware, that interest rates have dropped pretty substantially. We shot up a little bit from the second quarter to the third quarter. So you see the actual numbers here. Segment 1, which is the short term, it jumped up from 0.52% to 0.6%. And then the intermediate term, segment 2, from 2.29 to 2.73, and then long term 3.05 to 3.57. So we had a pretty substantial jump for people who retired in the second quarter versus the third quarter. For people who are looking kind of towards the end of this year, what we're projecting, and again, caveat here is this is a projection, kind of looking at trends in market rates. We're starting to see things leveling quite a bit, and actually on the longer term, we've seen a little bit of pullback. So the projection is a little bit lower. So the idea, and again, we'll kind of confirm as more data comes out, we get closer to that point in time. But the good news, if people are kind of looking at Q3 versus Q4, the movement in interest rates has not been substantial and should not materially impact the lump sum value based on these projections. Okay, so I think we had a question about the delaying the pension. So what are our options if we are retired or reach that full retirement eligibility and are not yet 55? So key thing is, first we have to make sure, do we have after tax, we have money that we can live off of if we're transitioning to a different role. Once we get to 55, we can take money from your 401k, your savings plan. So that's an option as well. So we do take a discount. They discount the annuity roughly 5% a year prior to age 60. So if you do take the lump sum as part of that calculation, excuse me, let me go back. As part of that calculation, they will show the discount. So if we do initiate the lump sum or take the pension prior to 60, you will have a mild penalty for doing so. But a greater impact than potentially starting it early is the impact of the interest rate. So what we've seen with the impact on interest rates, with them dropping at the end of 2020, beginning of 2021, the drop in interest rates has made the lump sum, much more attractive, and it has more than offset the penalty for starting prior to initiating the lump sum rollover prior to age 60. So we've seen that a driving factor and tends to have a bigger impact on the calculation of the lump sum. But again, if you're looking at the annuity, if that's your risk profile, what you want to look for is you don't have to worry about the interest rates. It's looking at the start date. So if you start before 60, roughly 5% reduction in the annuity per year prior to age 60. One of the things we also want to just kind of bring to the attention, in particular for our Exxon folks, is kind of a potential, put in front of you a retirement roadmap. So this is kind of a sequencing of events, excuse me, to show kind of the critical execution dates that someone needs to be knowledgeable about if they are planning to retire end of year and have a benefit commencement date in January of next year. So this is kind of example. Typically, the intent to retire package earliest can be requested is about 120 days out. So you inform your supervisor in writing of your intent to retire. And then, so last day on the payroll, first day of retirement, and then benefit commencement date there as well. And then it typically takes 30 days for that intent to retire package to come in. And then it's very important to get that submitted at least 35 days prior to your last day on payroll in order, if you're doing the pension lump sum, to get that check as of the benefit commencement date there. And then progressing beyond that, once Voya, the custodian of the savings plan, has been notified, you can do a savings plan distribution of, if you have Exxon shares that you want to do NUA with, or tax paid balance, which we have webinars kind of discussing, you have that opportunity to do that post-retirement as well. So kind of a general roadmap guideline for timing for folks who are on the fence or potentially looking at towards the end of this year and retiring at that point in time. Okay, so yeah, again, very important is have a plan, create a budget. Making sure you kind of have a handle of your cash flow needs now. It's very easy when people are working, the paychecks coming in, not to really have a handle of what your expenses are. And then if we get involuntarily retired, making sure we have those in place, and then looking at your risk profile as well. And then here's just a quick summary of that roadmap again. And then thank you guys very much for attending. Please feel free to reach out with any questions. As I mentioned, consultations are always done on a complimentary and confidential basis. So we'll be happy to help out if any specific questions pop up. But as I said, thank you very much for your time, and I hope you'll have a good rest of your day.